Okay, let's look at the long-term metric of a company. We have shareholders investing money in our company. So, what are they going to look at? How do they understand whether their investment has come good or not? Uh, so, to understand this, let's assume that you have 1,000 rupees and you go deposit it in a bank. Will you get some returns from this 1,000? Yes, the bank is going to give us about 8 or 9% return on the investment or the money that we have deposited in the bank. So if the bank is giving us 8 or 9%, isn't it fair for the investor or the shareholder to expect that the business gives him or her a little more than 9? Because if they wanted just 8 or 9%, they could have as well gone to the bank and put this money. Since they are expecting more returns, they want to put the money in a business which is also more riskier, because if the business makes loss, they will also lose their money. So higher the risk is, higher the expectation of the reward or returns that they are looking at. So to understand this, we're going to have one metric called return on shareholders equity or return on equity. This talks about what do the shareholders get for the money that they put into the company. And when we talked about what the shareholder gets during our profit and loss and balance sheet session, we saw that whatever the profit or loss a company makes goes back to the balance sheet as the retained earnings. So the retained earnings is the sum of all the profits and losses that the company has made. So we can say ROE is retained earnings by equity, which is the money that a shareholder is put in. To understand this, let's take a small example. Let's say you're looking at setting a shampoo distributorship in the outskirts of a city. And you have three options. You could either work with Dove, Head and Shoulders, or Vatika. And you have to make a choice, but all these companies want you to have exclusive dealerships or distributorships. You cannot work with two or more companies. You can only work with either of these. And when you go talk to these people, the Dow person says, if you sell one bottle of my shampoo, you get 10 rupees profit. When you go talk to Head and Shoulders, he says you get 5 rupees profit per bottle, and Vatika will give you 4 rupees profit per bottle. So, which business would you want to be in? Dow gives a profit of 10, Head and Shoulders a profit of 5, and Vatika a profit of 4. So, let's have a quick poll. How many of us would go in for Dow? Can you please put your hands up? Okay, that's quite a lot of us. How many for Head and Shoulders? Okay, and Vatika? Okay, not a lot of us. So you also know that to get this profit of 10, 5 and 4, you buy them at certain prices and sell them at certain prices. These are stipulated by the company. These are not things which we can influence. Okay, so now when you're just about to go and sign a deal with Dow, you just try to go and understand what happens in the market. So let's say when a small market survey is carried out, you realize that the market for Head and Shoulders is very, very high in this business. And of course, we talk about a 20 rupee, 25 rupee bottle. So I would assume the bottle size is a little small. So let's say the market size for Head and Shoulders is fairly huge. And you realize that for every one Dow bottle that sells, you have 5 bottles of Head and Shoulders and 1 bottle of Vatika which sells in this market. So in this case, which business would you go with? Whom would you sign up with? Okay, a lot of us say Head and Shoulders. Why? Because every day you can sell 5 bottles of Head and Shoulders while you can only sell 1 bottle of Dove or 1 bottle of Vatika. So if I look at the total profit that you get per day, how much is it when you sell a Dove? So you get 10 rupees per bottle into, let's say you can sell X number of bottles. That becomes 10x. For Head and Shoulders, 5 rupees per bottle into 5x bottles, which is 25x, and for Vatika it is 4 into 1 bottle, that is 4x. So the profit in Head and Shoulders seems very high, so a lot of us might of course go with Head and Shoulders. So when you're just about to go and sign a deal with Head and Shoulders, the manager from Vatika comes running and says, hey, I have a deal which you cannot refuse. The other companies are asking you to make a down payment of 100 rupees. But then he says, I'll give you an offer. He says, give me only a down payment of 10 rupees. The remaining 40 rupees you can pay me after a week, after you do your sales. So in this case, what is the profit that you get from Dow? You get 10 rupees, assuming that you do 1 unit of Dow, 5 units of Head and Shoulders, and 1 unit of Vatika a day. And when you sell Head and Shoulders, you sell 5 Head and Shoulders, you get 25 rupees. And when you sell Vatika, you still get 4 rupees. So which business should we go with? Okay, some say Vatika, some say Head and Shoulders. But why Vatika? Yes, Vatika because it gives you 40% return on the money that you're putting in. Head and Shoulders gives you 25 for 100 rupees. So 25 is still greater than. So we have two options. But then let's ask this question. Let's say, is oil and gas exploration a good business to be in? Is it a profitable business? Yes, it is. For example, like you said, Shell is a company which has not only been a Fortune 500 company, but for a good part, it's been a Fortune 1 company, top of the list every time. So it should be fairly profitable, and it is. But the question is, why am I not into the oil and gas business? Why am I standing here? Yes, that's because I don't have that kind of money to invest in that business. So, as an entrepreneur, as a businessman, I'm not worried about which business gives me greatest returns. I'm worried about, for the money I have, which business is going to give me great returns. So, let's say that as an entrepreneur, your investment is limited to 100 rupees. Let's say you have only 100 rupees with you. Which business would you invest in? So, if I were to have 100 rupees and if I were to invest the same money in a Vatika business, how many units can I buy with this 100 rupees? Because I'm making a down payment of 100, 400 rupees they are willing to give it to me as a loan. I can buy 10 bottles of Vatika, and if I sell those 10 bottles of Vatika, what is the profit I'm going to make? It's 40 rupees. And again, the market size in most cases is big, but it's only about how much of that can be captured, how much of it is doable by us for the investment that we make. So, summarizing this, as a shareholder or as an investor or an entrepreneur, I look at a lot of things before making my investment decision. The first thing I'm going to look at is margins. In case of Dow, the margin is 10 rupees on 100 rupees, the profit, 5 rupees on Head and Shoulders, and 4 rupees on Vatika. I'm also going to look at how much of sales can I do. In the first case, I could do 1 time the sale in Dow, 5 times the sale in Head and Shoulders, and 1 time the sale in Vatika. But I'm also going to look at how much of my money do I have to put in. This 400 rupees that we see there is what you can call credit. So how much of credit period am I getting? How much of someone else's money can I use? But how am I going to make a decision? Is it going to be based only on either of these factors? No. I'm going to look at how all these three things put together is going to give me returns. For the money I put, how do all these three things combine to give me return on my equity or the money that I have put in? So to summarize this, we have something called the DuPont analysis. Your DuPont analysis links the following ratios: return on sales, asset turns, leverage, and return on equity. So let's take a look at these terms one by one. Return on sales. Return on sales is generally your net profit by total sale, the last line of your P&L divided by the first line of your P&L. So in case of Pantaloon retail, it is 1.63%. In case of Larsen & Toubro, it is 8.15%. So what kind of a business is Pantaloon in? Pantaloon is in the business of retail. And what is a typical trait of a retail business? A retail business would usually have low margins and very high sales or volumes. So of course, Pantaloon is in the business of retail, but it's in retail of apparel, retail of garments. So, and Larsen & Toubro, of course, is an engineering company, fairly high margins. And coming to your asset turns, asset turn talks about how efficiently are you able to use your assets. How much sales are you able to generate from all your assets. If you look at Pantaloon retail, they have an asset turn of about 1.36 times, but for ICICI Bank, it's only 0.1. But why is it so low for ICICI Bank? So let's ask this question: what does a bank sell? Loans, okay, and what is an asset for a bank in that case? So the asset for a bank could be your buildings, maybe the ATMs. For all you know, it could be a lot of other things. But then let's ask this question again. In our definition of asset, how did we define asset? Is it a cash in or a cash out? It's a cash out. Will it come back in the future? Yes, we said asset is a cash outflow which will come back in the future. So for a bank, what is a cash outflow which will come back in the future? Yes, that's your loan. So the bank gives money to other companies hoping that they will give it back in the future. So an asset for an ICICI Bank is the total loan that they have given out. And what is sales for an ICICI Bank? So let's ask again, what is sale? Cash in, cash out. It's a cash inflow. Do we have to give it back? No, we don't have to. So what is a cash inflow for a bank that they do not have to give it back? That's your interest rate. So what I see here is the total interest that ICICI Bank gets on all the loans that have given out is 0.1, which means approximately ICICI Bank is charging an interest of about 10%. Okay, and this again is a typical trait of the financial service business. The asset turn would be fairly low. And coming to your leverage talks about how you build your assets. Like we said, you can build your assets using your own money, or you can build your assets using someone else's money. In case of Larsen and Toubro, it's about 1.39 times, but in case of ICICI Bank, it is 7.84 times. But how is it? I thought banks usually give us money, but here it says banks are using someone else's money. But whose money is that? Yes, that's our money. So what does the bank do? Bank takes our money at a lower interest rate and gives it out to other people at higher interest rate, and they keep the difference to themselves. That's how a bank works. So what your DuPont analysis says is that your ROE depends on all the three ratios that we saw, and of course different industries are going to have different ROEs, different ratios, and we'll have to understand it with respect to how an industry is performing. So your ROE is ROS, return on sales, into asset turns into leverage. And if you put it mathematically, we saw that your ROS is profit by sales, your asset turns is sales by assets, your leverage is your assets by equity, and if you multiply all this and cancel it off, simple math, you will end up with profit by equity. But the question is, why can't we just calculate profit by equity? Why are we going through such a complicated, convoluted method? There is a good reason for that, and we'll also look at why it is. Your return on sale talks about how much money are you making on each sale. So in case of a Dow, it was 10 rupees. In case of Head and Shoulders, it was 5 rupees. And in case of your Vatika, it was 4 rupees. Your asset turn talks about how do you maximize your sale on each asset. So in case of Dow, it was 1. In case of Head and Shoulders, it was 5, because by putting in some money, you're able to do your sale 5 times over. In case of your Vatika, it was 1 again. But when you look at leverage, leverage talks about how you build assets with less equity. In case of your Head and Shoulders and Dow, your leverage was 1. But when you look at what happened with Vatika, you didn't need to put in all your money to build an asset, which was your 1 unit inventory of a shampoo bottle. You put only 10 rupees, but you got an asset worth 50 rupees from your supplier. So here in case of Vatika, the leverage was 5, and all these three things put together help you understand how to drive ROE of a company. So with this, let's take a small example. So I'm going to give you 3 companies: Coke, Goldman Sachs, and Walmart, and you'll have to tell me which company is what. I'm going to give you the ROEs of 3 companies. You'll have to tell me which ROE corresponds to which company. First of all, you have company A, B, and C. A has 27.1% ROE, B 3.7, and 3.22. C is 22. So which is Goldman Sachs, which is Walmart, which is Coca-Cola? Okay, the answer that we hear a lot of times is B is Coca-Cola, because they have low margins. Okay, but then let's ask a question. Of course, Walmart in the business of retail, low margins, high turnaround. But the question is, what is margin? Is this ROE margin or is this ROS margin? So let's take this. Now you'll have to tell me, and when we see it, we know that this ROS is the profit margin that we're talking about, and ROE is not the profit margin, that is just your return on equity. So if I'm going to give you your ROS figures, would it be possible for us to understand which company is what? So one company has a fairly low ROS, which is 3.57, another company 9, and another company 18. So there is a probability that C could be Walmart. But then let's also look at what the asset turn numbers are. When I look at asset turn, one company has 2.29 asset turn. So this could possibly be Walmart, because this company has a high asset turn and a low margin. Low margin, high volumes, very typical of the retail business. So there's a lot of probability that C is Walmart. But between A and B, which is Coke and which is Goldman Sachs? So one company has a low asset turn, one company has a high asset turn. And which kind of companies have low asset turns? Usually are financial service companies, but without taking a guess, let's also look at the leverage numbers. This company which has a low asset turn also has a very high leverage. And when I look at a company which has very high leverage, I can possibly say that is a financial service company. So I can say that company C is Walmart, company B is Goldman Sachs by means of having high leverage and low asset turns, and by elimination, company A is Coke. And of course, if you look at a business, the margins that Coca-Cola enjoys are very, very high. A Coke enjoys anywhere between very high margins, and we have heard stories about how much a bottle of Coke costs to bottle, anywhere between 5 paisa to 50 paisa to 1 rupee. But the fact is, all of us know their cost is fairly low. So the margins that they enjoy are also very high.